again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Thursday, September 28th. We're going to talk about the three topics that are moving markets. We're paying attention to. You should be too, so thanks for watching. So markets are moving. There are no let up in yields, treasury yields, or interest rates, if you will, simply because inflationary pressures are still within every aspect of the economy, and that's playing out in the market real time today. As well as oil prices are on the rise again, and there's little progress made for a government shutdown this weekend. But that's what the market has been worried about. As soon as we opened trading this morning, markets sold off. Why? Because the 10-year and the 30-year basically broke out higher again. As we said a few weeks back, it was the 4.34 on the 10-year Treasury was the ceiling of the previous sort of cycle high. If we broke and closed above that, which we did on the 10-year Treasury, it was inevitable from a structural or even a technical support level, markets will break out higher. And that's what we saw. And this is a chart both of the 10-year and the 30-year that pointed out exactly what we discussed weeks ago. And we're prepared for it because we're allowing treasuries to roll higher or the fixed income markets to roll higher. As I said, we are positioned in short-term duration instruments, cash, and a few other sort of T-bills. And as soon as that comes due, we lock in higher duration, longer duration and higher rates for our clients. So if you're on an income side of the game, this is a benefit. But if you're in the market and you're watching sort of the equity market, you're watching the inverse relationship play out, meaning if higher interest rates are all around, the equity market or earnings or the future earnings come down. And there's a lot of reasons as to why. But let's just take a look at this right now. The moving averages in the 10-day and the 30-year. But very specifically, we're seeing this right here, this breakout, okay? And in fact, the 30-year had a 4.76 breakout high before it started reversing today. And that was the highest since August of 2011. So yields are moving higher. Yields did reverse intraday, and that's why the market is up as we speak, as we film this. And so that's that inverse relationship playing out real time. But what's the real issue here? The real issue here is too much spending, lack of fiscal discipline. Ultimately, we're spending $17 billion a day in the past 3 months. That's $500 billion per month. And the past 5 years, the U.S. debt, has grown to $33 trillion, but it's up over 54% in the past 5 years. This has never happened in the history of the United States, even post World War II, when we had to fund, the war. This is a major issue, and it's a major issue right now because ultimately it's a supply and demand issue. Why are interest rates or yields going higher? Because you have all of this debt that you have to fund. So the Treasury goes out and sells T-bills. The market knows that there has to be more and more and more T-bills coming their way. So why would you lock in a 4% Treasury when you know that a 4.5 is right around the corner, maybe a 5% or maybe a 5.5? And ultimately, that's what's happening. The marketplace, on a supply and demand standpoint, is pushing away and stepping away from the table of buying those treasuries. The treasury yields have to go higher to make it more attractive for the market to come back in and say, okay, I'm going to buy that. But again, why would you step in today when you know tomorrow you're going to get a better deal? It's supply and demand, and that's ultimately what's playing out. And as we talked about it, we're at 33 trillion. I know that we have Congress divided right now. I know that we had a political debate last night. I don't believe that anyone's really serious, simply because we're still spending money in a government level as if we're in a recession, as if we're sort of post-COVID. We're spending money we don't have, and that's really what the market is telling us. In addition to higher interest rates because of higher inflation and supply and demand on the treasury markets, we then couple that with higher oil prices. Again, we spoke to this. We added energy as an asset allocation sort of sector, an additional add to our client portfolios earlier this year when energy was down. And now we see crude oil, breaking closer to 100. And this morning, some of the top analysts said, oil could go to 150. And that's because the Saudis and China and Ukraine and Russia and everybody together are going to make certain that the prices are going to go higher, even though we have the opportunity for energy independence in the United States, but we're going to be subject to what everyone else can basically get on the open market by controlling supplies and prices. So, and as we're saying, listen, we've set up for this. This is a sector sort of breakout of what is outperforming the S&P 500, and the bigger the bubble size on this, the more that the stocks in that sector are outperforming at large. So right now we're seeing energy is one of the best performing. Over 80% of the stocks in the energy sector are outperforming the S&P 500, and we're seeing strong trends. We're also seeing information technology, which we own for our clients, so on and so forth. And we talked about, utilities and consumer staples. Those are the laggards. We don't have a lot of allocations in our portfolios to this, but we have allocations to your information technology, your industrials. We've talked about consumer discretionary. Those are outperforming a majority of the stocks within those sectors. Now let's get to the final aspect. Again, one more thing to worry about, at least what the markets are worried about, is the government shutdown. And as we just laid out for you quite clearly, are they going to spend more money? And the answer is yes. So my take-home point is the government will be shut down. Certain essential services will still be up and running. Let's call it like air traffic control, if you will. I think that's kind of critical to keep moving sort of the ball forward, if you will. But others will be shut down. One specific aspect, which is interesting, is the government data, that the government and the Federal Reserve rely upon. Well, that department, right, the number crunchers and the economists, that will be shut down. Why is that important? Because all of the important reports, like everything that has to do with the economy. So let's talk about employment or unemployment, and everything won't be sort of turned in on real-time basis. That could mean that the Federal Reserve might not have real-time data. That could mean that the Federal Reserve might not raise interest rates because they're going to be more data dependent, but the data that they have is sort of 2 months old, not 1 month old. Ultimately, if the Federal Reserve needed to pull some strings to get that real-time information, I'm pretty certain they could. But it could be a good sort of headline opportunity for Jerome Powell and the Federal Reserve to use that as a, hey, quote unquote, we don't have all the real-time data, so we're going to see what the lag effects do, even though we have higher for longer policy, and we need to keep interest rates higher because we need that nominal rate to go down to 2%, that target long term, sort of 2025-ish is sort of the target there. But other than that, we shall see some drama play out and see if Congress is serious, both House and Senate, and they are all to blame, and they're all in on this together. And I think there will be 11th hour deal. I don't have confidence it's going to happen sort of this weekend, so I wouldn't hold our breath on that one. In any event, it's October. Who knew? Who could believe it? So get the pumpkins out, and let's watch the leaves turn, and just enjoy the cooler weather, at least here where we are in the desert. So thanks for watching our market insights and observations. Take care. Make sure you share with friends and family, and we'll see you again next time.